Hi, folks, and welcome to the Meaningful Money Podcast. This is session number 334. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Here we are once again. Great to have you with me. Thank you for joining me. Now, continuing in this sort of slightly impromptu ad hoc sort of series, interviewing luminaries in the world of wealth building and financial independence. Today, I'm chatting with Andrew Craig, author of this book, How to Own the World, founder of PlainEnglishFinance.com. He's another person that many of you have asked me to get in touch with. A few of you in the Facebook community have mentioned How to Own the World, Andrew's book, and I think you're going to enjoy this one. Andrew is a real kindred spirit, so looking forward to bringing you my conversation with him. As usual, after that, I'll read a review that's been left recently, talk about what we're going to be discussing next time. But before any of that, remember, this podcast continues to be brought to you with the help of my good friends at Seven Investment Management. They've been helping me out here since 2011, which is a long time, and shows great commitment and support on their behalf. So thank you to them. Please do check out what they're up to, 7im.co.uk. That's the number 7im.co.uk. Go check them out. Oh, and don't forget, Meaningful Money branded self-investment platform at meaningfulmoney.tv/podcastinvest. meaningfulmoney.tv/podcastinvest. All the information you need is there for that. Right, Andrew Craig sent me the latest edition of his book. It's quite an achievement, really, to have a book in its third edition, right? Now, as of recording the interview with Andrew, I'm only about 2/3 of the way through it, which is a bit annoying. I sometimes struggle to get through books before I have to have the interview. So I managed to sort of skim read the last third, but it really is an exceedingly good dealing with the subject. He's a very bright guy, clearly, with an awful lot of experience. He really knows his stuff, and he has a clear passion for communicating this message about simple investing, simple financial steps that everybody can take. Really, the book it has certainly earned its place in, I think, certainly the top 5 books, I think, for personal finance in the UK, but it speaks wider than that as well. So definitely check it out. There's a link in the show notes. In fact, everything you need related to my conversation with Andrew Craig today is at the show notes. And the link you need to remember is meaningfulmoney.tv/session334. meaningfulmoney.tv/session334. Without any further ado, here's my conversation with Andrew Craig. Well, it's my pleasure to welcome Andrew Craig to the Meaningful Money Podcast. Andrew, how you doing, man? You doing okay?
Very well, thank you very much. Delighted to be here. Very kind of you to have me.
It's great. I'm excited for this one because you very kindly sent me your book, and I get sent a few, obviously, things to read and people to talk to, but I immediately identified that you were a kindred spirit. All right, I know we've already mentioned that before we hit record here, so it's great to have you. Yeah. Andrew, do you want to just give us a quick bio, man? Who you are, what you do, and particularly how you got to this point? I think it's important that people know, how people got to the stage where they've written books and all that sort of stuff.
Yeah. Well, it's a very incremental thing, isn't it? You never wake up and think, "Well, I'm going to write a book today." It just sort of sneaks up on you. But so I suppose I would say I was a pretty plain vanilla kind of studied economics and politics at university at Birmingham Uni. Came out, actually managed to get an internship in Washington DC the following summer. Yeah, it was this amazing program, which sadly doesn't happen anymore. But for sort of from 1919 until about 3 or 4 years ago, when Trump and everything changed America's ability to allow young ingenue Brits over to DC. They sent, I think it was like 12 Americans came to Westminster and 12 Brits went to DC area. And the only reason I mention is that I think sort of having a 2-1 from a red brick uni like Birmingham in economics and politics probably wasn't enough to get me into, Goldman Sachs or Swiss Bank or Merrill Lynch back in the day. It was just too competitive. But coming back, having just done a summer's internship with a US congressman and writing speeches and stuff, made the difference.
Good CV fodder.
Yeah, well, exactly right. And I highly recommend, whenever I'm sort of mentoring young people or whatever else, I always recommend that it's all about little incremental steps. Where getting from A to B and whatever you want to do it's much easier to, getting to the next little step means you can then go to the bigger step. Maybe I'm slightly going off piste a bit there, but no. So basically, came back from the States and interviewed with all the big investment banks and the Foreign Office, and I was thinking about all sorts of different things I might do, and ended up being a sort of evil city boy, basically a plain vanilla stockbroker. So at Swiss Bank, SBC Warburg, as it then was. Shortly after that became UBS, which is the brand that's still around today, which at the time was a pretty dynamic place to be. It was great. There were quite big businesses in America, and they really had pretty much the biggest equities franchise in Europe. So I was really, really fortunate at the age of, early 20s, basically, to be kind of in the UK small or the European small cap equities team that did things like floated lastminute.com.
Wow, yeah.
And EasyJet and Burberry and Campari and all these amazing companies. And I was sort of, I remember going around being in Milan airport, sort of chasing the management of Campari with literally 12 bottles of Campari on each shoulder and my luggage, dragging it along. But, what an experience to hand out a bottle of Campari at each of the meetings. So did that for quite a few years. Worked for the Swiss for several years, then worked for the French, worked for Crédit Agricole, and then latterly worked for the Swedes for SEB, so one of Sweden's biggest banks. But and I found myself basically, why did plain English finance happen? I found myself living in New York and working for Crédit Agricole Chevreau. So for people who don't maybe know much about banking, my job was basically to call up people who run money, so hedge funds, institutional fund managers, insurance funds, who might have anywhere between $200 or $300 million, euros, pounds, whatever, or even as much as 3, 4, 5, 10 billion, and say, we think, our analyst today has written a research report that says you should buy Porsche and sell Airbus, or EasyJet or LVMH or whatever, which, by the way, is an industry that is dying, and maybe we can come on to that later, which is part of why I changed gear. But I basically woke up one morning in the middle of 2010 and sort of thought, wrong job, wrong city, wrong girl. Really, yeah. I probably shouldn't say that on a podcast interview. Hopefully she'll never see it. But basically just decided to change all three. Dynamic. I was reading a lot of books on entrepreneurialism and stuff. I thought, I'm going to have a crack at something, and so I came back to the UK. Back to my bedroom at my parents' house, and which was a bit of a change from a sort of cool apartment in Manhattan. But and basically sort of thinking about names of businesses. I just had this idea to start a kind of financial, I was an angry young man who was fed up with just how financially literate, everyone was. And weirdly enough, even people who work for top investment banks, because they're so good at their own little niche. You could go some sort of credit derivative salesperson at Goldman Sachs or whatever and say, "Well, have you got in your pension?" And they go,
I don't know.
Oh, I don't know, actually, literally. And so I just sort of, it was not even that I saw it as a market opportunity. I had a bee in my bonnet. I thought, right, I'd floated a few internet advertising companies, so I knew how to do affiliate marketing and stuff like that. So I thought, if I just my original plan was start a website, and then I alighted on plainenglishfinance.com.
Nice.
Which, well, yeah, at the time, people took the mick out of me. So, yeah, 3longwords.com. Fantastic idea.
Yeah,
it seems to have worked out all right so far. But that was the sort of brand. That was what I wanted to be all about. Plain English finance, genuinely. Started the company, started the website, and basically after I'd written about 100,000 words of content, which was just essay. It was all pouring out at me. What is a bond? What is a share? What are interest rates? Why are IFAs, not very, so, not the whole industry, as we talked about earlier, but, actually my cousin, bless her, said to me, one of the early supporters of the stuff I was writing said, nobody wants to read 100,000 words on a website, because I was such a naive, it was sort of like, get to the end of the page about shares, click here to read about gold, or whatever. And so what was that? It was sort of early 2011. And I then, just through pure luck, my brother's best man, a guy called Tim Peacock, is a superb kind of, he's head of digital technology at a FTSE 100 company now. So what he doesn't know about how to kind of, integrate with Amazon or affiliate marketing, whatever. And happily, I gave him a bit of equity in the business. He came on board, part-time. And that led to that 100,000 words became what was then called Own the World. and he helped me figure out how to self-publish that on Amazon. And so Own the World then in its second edition, so that was in 2012. Weirdly enough, lots of 5-star reviews, selling surprising number of copies, despite the fact that I look at that, we both look at that version now. It's like a bright blue, horrible looking homebrew, version of the book, first edition. But people liked it. It resonated. It started selling well, and not all the reviews were written by kind of, my family. And then we spent a bit of money in 2015 to do a second edition, and that basically meant we employed a lady who used to be Penguin Nonfiction. So the second edition had, an index and much better graphics, and wasn't such a poor quality product. And then that sold even better. And so, the third edition, I then was really, really excited and delighted last year, because in sort of early 2018, a lot of else happened at the same time, which I'm sure we'll come on to, but I got approached by Hodder and Stoughton, which is, next to Penguin, basically one of the biggest publishers in the world, saying, we've been quietly following the sort of success and sales trajectory of your book. How about a book deal for the third edition? And so I fell off my chair and
brilliant.
grinned from ear to ear before I realised that, that meant that 30 weekends last year, basically, I spent, sitting, sweating away through last summer in the office.
You make a comment I think in the preface of the book, how much harder it is to update an existing book than write a new one. That's
right, and not least because the main difference between the third edition and second edition, that Bitcoin and crypto had all exploded, and the book's called How to Own the World, and the basic insight is that you should own all assets in all geographies, which it's never been easier to do that than it is today. And I was well aware of Bitcoin and crypto in 2015 because I'm a finance geek. And actually a guy who I've interviewed with and followed for a long time, Dominic Frisby, who's the resident precious metals and crypto guy at Money Week. I'd read his book on Bitcoin, which I think was published at the end of 13 or maybe middle of 14. But for the second edition, it was too nascent an asset class, so I left it. But last year I read 24 books on it and went down the rabbit hole numerous weekends in order to produce, I think, 12,000 words, and so a university dissertation's worth of new content to go in the book.
Yeah, amazing.
And then the biggest work actually was doing the audio book.
Oh yeah.
I would never wish that on anyone, especially when you've got the flu and it's January and you basically work all week, go to a little box recording studio in King's Cross all weekend. Trying to say words like...
It's funny, I love doing mine, but then I spend my life talking into a microphone. So.
I suppose, A, I was ill.
Yeah.
B, it was like dark and nasty time of the year. I had a deadline looming, and most importantly, saying the word quantitative easing. So I had to say quantitative easing about, 50 times. More fool me, because I'm the one who wrote it, right? But... a number of times, red light. Can we just record that one again, please? Anyway, so the rest is history. So that came out on March the 7th.
Yeah.
And it has. Last time I saw it published, it was the best-selling new finance title in the UK this year. Which
brilliant. Well, congrats, man. Deservedly so, because it is a masterful piece of work, and
thank you very much.
I think is the biggest challenge for people like you and me when. Where spend our lives in detail very often is refining that and distilling it to the stuff that people really need to know without all the stuff that they don't necessarily. And I think you've done a great job of that. Obviously, the book itself is, I imagine, I'm putting words in your mouth, a sort of distillation of all the work that you've put into plainenglishfinance.com and your views on how personal finance should be done. If you had to summarize that, in a few minutes now, how would you do that?
So I suppose the book was two things. Firstly, it was the nuts and bolts of all the sort of basic, unchanged information about what's a bond, what's a share, what are interest rates, what's inflation, what is the bond market, what is it, so all that, and then layering on top of that an actual sort of investment worldview, so not just info like encyclopedia kind of or Wikipedia kind of info about what is a bond, but then. Okay, so now we know all that stuff, and we've got a basic grasp of it. How do we actually invest successfully, no matter kind of... And my big shtick, if you like, which I really believe, is that it doesn't matter what financial markets are doing. You can be financially successful. Most people are really scared of investment, and what I try to communicate is that you don't need to be. And there's a very simple reason for that, and that's, if you like, the worldview overlay, the investment overlay, which is, the richest and smartest people for the last 200 years or more, since bonds and shares were invented, basically, have all got, or many of them have in common, this particular approach to investment, which I call owning the world. And all that means is, if you are able to own all major asset classes in all major geographies of the world, that has as I say, basically a 2-century track record of banging out high single-digit, low double-digit investment returns, whilst massively protecting the downside. So, if that's good enough for Oxford, Cambridge, Harvard, Yale, the Rothschild family, and every smart family office in history, and for people who don't know what family office is, basically anyone who becomes a multi-millionaire or a billionaire, that JP Morgan wrote a piece of research in, I think, either late 90s or early noughties, became quite famous, saying that 90% of rich families have lost their wealth 2 generations after the person who made it. So actually preserving wealth it's quite rare. And so a lot of those very wealthy families, to guard against that, start a thing called a family office, which is basically where they employ investment professionals to run their money. And all of these people, I mean, not all, but I would say comfortably the majority, approach investment with the same worldview that I've tried to articulate, owning the world. So the insight is that basically many people, when they think about investment, only have property and cash, in the UK particularly, obsessed with, I'll come on to that in more detail. But if they do have stock market investments, they basically just have the FTSE, or they have, a UK pension fund, which is a mixture of gilts, so UK government bonds, and UK equities. And what I talk about is being diversified by geography and by asset. So by asset just means that don't just have shares or property or cash, have bonds, commodities, basically every single asset class that exists, all the major ones. And then geographically, it's actually quite simple these days. All you need to do is own, the American block, the European block, and I include the UK and the European block for the time being. But I mean, I'm really talking about time zones rather than political demarcations, sure. and Asia Pacific. And I suppose, if you like, the secret sauce, to the extent there is any, of my book was, rich people have invested like this for 200 years because they could. Harvard's got Goldman Sachs on speed dial, or Charles found their own investment banks in the 1850s, so they could own gold and property in Frankfurt and New York. But for the average person with 100 quid to invest and 50 quid a month to put in an ISA, it's only really recently, thanks to innovation in financial services, that anybody can do this. And so, and I suppose I'd identified that in the book, and so it's really walking people from being effectively financially illiterate, which sadly enough, British schools. I've got an economics degree, and I came out of Birmingham University with a solid economics degree, and I couldn't have confidently invested in what were then PEPs, or maybe ISAs by then, but and I wouldn't have been able to sort my pension out, even though I had a degree in economics. It's very, very poorly taught and doesn't really exist in the general population. Right. And so it's like, here's the nuts and bolts, and then here's this worldview. So why does it work? Well, if you think about 2007, 8, 9, the S&P 500 fell 56% in the global, as the Aussies call it, the GFC, the global financial crisis. So, and most stock markets around the world fell by 50% or more. Some of the emerging markets fell by a lot more than that, as you know, obviously. Stock market investment's dangerous, blah, blah, blah. Yeah, but in 2008, oil hit an all-time high of $147 a barrel in the summer of 2008. And in 2009, gold was up 19.5%. And so, and I'm not the first person to have come up with this idea, right? But so the basic, the global multi-asset investment works. And I used to say it'll never give you 20% plus years, but actually that's not true. Weirdly enough, it does, and it can. But most importantly, what it does is it never gives you minus 50% years. Yeah, sure. Because in the years where stock markets fall, all the negatively correlated things you own, so that might be gold or oil or energy commodities, whatever else, go up. And so that, when most people really grasp that, they then it's a sleep at night way of investing. You can make good real returns and not get hosed, basically.
That's so important, isn't it? One thing that I picked up, obviously, in the book is that you generally advocate a higher allocation to commodities, particularly, and metals.
Yeah.
You talk about at some length than perhaps
most
others.
People.
Most others. So, for instance, I had Lars Kroyer on the show a few months back. Love Lars to bits. A very, very clever guy. His book, Investing Demystified, he sort of simplifies it to, well, actually, global equity portfolio and then basically some home-denominated, for us, gilts, as a sort of thing. So, and I don't think he talked about commodities at all. Now, I always talk about multi-asset, which would include, obviously, alternatives like property and commodities, real estate, all that sort of stuff. So what's the thinking particularly behind the higher allocation to commodities than most might advocate?
So I'm reaching for... So I mean, basically, firstly, I think let's talk about what's called the break-even fallacy, the importance of protecting downside. Now, and volatility-adjusted returns. So you could just invest. So I often use the example of UK small caps. Elroy Dimpson and Paul Marsh at the London Business School have been researching UK small caps, the bottom 2% of the London stock market, basically going back to 1955, and their annualized performance is more than 15% per annum.
Amazing.
So but what's the answer to successful investment? 15% per annum will make you a millionaire in not many years if you're putting half decent amount in your ISA every month. But but the trouble is, along the way, there's massive drawdown. So there are years where you're up 35, you're up 45, you're up 20, but there are years where you're minus 60 or minus 70.
Averages cover a multitude of sins, don't they?
Well, exactly, and this is a big thrust of everything we do is understanding how important human psychology is and the difference between an annualized return and the actual return that you as a human being, with all your foibles and fear and greed and all that stuff, are actually going to achieve. And so I think, you could just own an MSCI World ETF for 2 and 6 months. It's a very cheap and efficient way of investing. But along the way, you're going to endure minus 50% every, 8, 10, 12 years, whatever it is, going back if we look at the last century. So all of the things being equal, I want to have a bigger exposure to commodities because there's a very long track record of that being a negative correlated to equities, therefore protecting a downside. So to go back to my earlier comment, so usually when the stock market and bonds are having a terrible time, usually gold shines. If you'll pardon the pun. I didn't mean to do that genuinely. And if you look at evidence of the last years, that's very clear. But it's and I was just, as an aside, I was going to say, Warren Buffett is famously bearish gold and calls it a barbarous relic and pointless and all that. And I'd just like to nip in the point that, not to take anything away from what a mighty figure he is as an investor in an investment. His mentor, Ben Graham, lived and worked and functioned as a professor of, stock markets, financial markets, and wrote in an era where you weren't allowed to own gold as a private individual in America. It was illegal from 1933 until 1977, I think. Right. Maybe, or 73, maybe when Nixon... Anyway, it was illegal for all of Ben Graham's career. It wasn't in any of his models or any of his thinking. Yeah. And neither was it in... And so gold was a kind of, it's the sort of ugly stepsister. That's a slightly pithy and correct way of putting it, but you get my point. Yeah. And I think, so and then if you look at what gold did in sort of, after Gordon Brown sold all our gold reserves, well done, Gordon. Yep. In round bottom, it went from 250 where he sold it to kind of 1900 at peak, whenever that was, end of 11. So gold certainly did its job then. And actually, I get a lot of criticism for being a big bull of gold. And people go, look at, the dollar, it's peaked. But gold's done something like 12% annualized going back the last 20 years in sterling. And it's now at a sterling all-time high. So people, you're worried about Brexit. You're worried about the pound now being, the North Atlantic peso. I've just come back from being on holiday in Italy, very luckily and happily enough. And my goodness me, do I feel, brutalized by how expensive everything is with the pound where it is. But at least I've owned gold for the last 20 years, so that helps. But then, so firstly, it's the negative correlation gives you smooths your returns and means that if you do have an allocation to commodities, you're less likely to have those minus 40% years that really, really carry you out. And for a lot of people, stop them from ever investing again. Yeah. Which is the worst possible outcome. And that happens to a lot of people. I'm going to get into stock markets. Now I know what ISAs are. I'm 33. I'm saving money. Invest in shares. Get completely hosed. Never invest in shares again.
Yeah.
Terrible, terrible problem that we have, and sadly is happening for a lot of millennials right now in crypto.
Yeah, well,
we can come back to that.
Yeah, interesting. You say in the book, Andrew, you use quite early on the word paradigm shifting, that your view is that really, I suppose, centered around the events in, or at least symptomized by the events of sort of 2007, 8, 9, that you believe the world economic environment is changing irrevocably.
Well, actually, so that dovetails neatly with the second point I wanted to make about commodities. Actually.
Okay, sorry. Yeah.
No, that's fine, because the first. Sorry, I'm too verbose and going.
No, you go for it. That's why you're here, man.
But the first one being, smoothing returns and protecting the downside, but the second one actually being a structural story, which is all to do with fiat money and the printing of money, which goes to what is the paradigm shift that I talk about in the book? Well, the paradigm shift is, originally when I first wrote the book, is acknowledging that since we came off the gold standard, money is basically a confidence trick. And the US dollar, euro, even sterling, they're all just great big Ponzi schemes now. The paradigm shift is that unlimited money printing, as evidenced by quantitative easing, and at the same time, an aging population. And those two things are very, very different in our era to kind of at any other time in history. So when you put those two things together, you really, really, really have to learn about finance and sort your finances out. Because if you don't, there is no government in the Western world that is going to be able to fund the pension, like a decent pension income for somebody who retires at 60 and lives to 100. It's just mathematically impossible. And there's nowhere near enough being said about this in contemporary discourse in the Zeitgeist. People are all bleating on about Grexit and stuff that we can come on to this.
Sideshows, relatively speaking.
I really do. I describe Brexit. A lot of people, I get a lot of hate mail for this, but Brexit to me is like the millennium bug. It is we're gonna look about 10 years from now and go, what was everyone moaning about? There'll probably be a short-term negative GDP impact, but I don't even know whether that's actually going to happen. To be honest, that has become accepted as gospel fact on the BBC. It's just not. Anybody who's ever built a DCF or any kind of macroeconomic model knows that you can make the numbers do whatever you want them to do in a macroeconomic model. So all of sort of anti-Brexit economists are saying it's going to be minus 10% GDP, and Patrick Mimford and all the guys who are pro-Brexit are saying it's going to be plus 10%. And the true answer is nobody knows. But what I do think gets lost is Australia and New Zealand have traded as tiny little economies on the world. I see all this stuff on social media about, England's a tiny, irrelevant, peripheral little economy. We're never going to be able to. We are. Now, I believe in the free movement of peoples, so I couldn't vote in Brexit because I'm not worried about immigration. I think we need immigration. I think we need high quality people and people to pick fruit, whatever else. But I also think I'm a very libertarian, small government kind of person. So I think that what we spend on moving the European Parliament from Brussels to Strasbourg every month is an egregious, disgusting waste of money. So anyway, there we go. I slightly went down an alleyway there, but
it has that effect, doesn't it?
Yeah, it does. But when all's said and done on that, I do think that all this concern about Britain being hammered by it, people worrying about the agricultural industry. Now, being a farmer is tough at the best of times, but they're only 0.8% of the population right now.
Yeah.
I don't know how we get so, well, I do know because they all have a vote, but we do seem to fixate on red herrings with Brexit. And I'm sure, just like I remember 99, 2000, when nuclear power stations were going to melt on, the millennium bug. And actually, it was all fine, and we all muddled through, and Britain did better than ever. So anyway, I've gone down a blind alley, but the reason for that was, I think a far, far bigger issue is the unbelievable black cloud pensions crisis that is coming down the pipe towards us. When I do speaking events, I talk about the bad news and the good news. The bad news is that to have the average British salary of about £27,000 of income at retirement, assuming you want to preserve your capital, let's say you want to retire at 55 and you're going to live for another 45 or 50 years, scientists are telling us. And, but I also do a lot of work in the biotech sector, and, it's remarkable what's happening in healthcare and cancer and dementia and Parkinson's and all these things are we're going to be close to effective cures for some of those things in the relatively near future. So people are going to live to 100. But under the current paradigm and the way that government approaches things and uses the bond market and QE and everything else, no government in the world apart from basically Norway and Australia for their own sort of structural reasons, is going to be able to fund a livable pension income for people between the age of 55 or 60 or 65, and when they die, if they're going to die at 100. It's just not going to happen. So, and I think that reality is part of what's causing so much partisan kind of polarization in society at the moment, because the people who get it, in America, Trump, people who get it are basically getting on with learning about and implementing investment. And, a lot of whom are, dare I flatter myself to say, I've converted people who didn't think like that. They read my book and then they do think like that, which in my own little way is my contribution to the problem in Britain, and beyond, hopefully, eventually. But, the people who don't get it and think that the government is, the government should just spend more on people. Well, they just can't. They can't. The economics just doesn't work like that. You can't spend money you don't have. So you ask the paradigm shift. It is governments have tried to paper over the cracks by inventing money out of thin air, which is QE. And that is why, a pound today is worth 90% less than what it was worth in 1973 when my parents bought their first house in London. And the same is true in America. And by the way, we will be earning the basic salary 20 years from now will be £500,000 a year, and houses will cost 10 million quid. And everyone looked like, because if you said to somebody in 1973, when they were earning 400 quid a year and a house in London cost £2,000, in 2019, you'll be earning, 60 grand a year if you're on a sort of, most London at that. I think the average in London is about 55 grand actually. Okay. A sort of common or garden family home will cost £1 million quid. They'd look at you like you're completely insane. But that is the the old John Maynard Keynes thing about not one man in a million understands inflation and really thinks about inflation. And so that we'll come on to property, because I know we will. But trying to disaggregate the difference between the nominal increase in the price of property in the UK and elsewhere versus the real increase is another thing that I think very, very few people understand. So, I bought a property for 100 grand and it's now worth 700 grand. Yeah, but so is every other property in the street. So have you increased your wealth in terms of number of homes in where you live? No, you haven't. But even though you've increased it in number of pounds, now property has outperformed inflation, certainly in central London and elsewhere in premium parts of the world. But anyway, I've answered the question at great length.
Yeah, no, it's great. I'm more than happy to let you speak because you know what you're talking about, and it's very accessible. I mean, you mentioned property there, and obviously I primed you with some sort of thread questions before this. And property, we have a sort of unique relationship with property in this country, don't we? I think certainly that's my perception, my sort of our view on it.
Well, exactly, because in mainland Europe, something like 2/3 of the population rent their whole life. Yeah,
exactly.
The normal. And we here, everybody aspires to get on the property ladder.
So what place has property then in beating inflation and wealth building generally? And, particularly what your views around people using debt to do that and all that sort of stuff?
Yeah. Well, I mean, I think whilst governments are keeping interest rates artificially low, it seems likely that property prices will nominally keep on going up, right? Mm-hmm. But it's the difference between the gradual, so I'm trying to do it that way, the gradual slope of the price progression in normal terms and the machinations of, the big juddering around it. It strikes me that I think the thing about property is like any other asset class, people need to understand the basic metrics in which to evaluate whether property is expensive or cheap. And 99.9% of people in this country do not possess the knowledge to do that. And neither do pretty much any estate agent I've ever met.
Right.
I mean, it's crazy. When I lived in New York, the estate agent who was in the sales office in my building kept trying to sell me, kept saying you should buy, and I was only living in New York for a little while, so I wasn't really in the market for buying. But, I actually think it's really quite simple. It's all about the rental yield. So, if rental yields are basically about 2%, which I hope my landlord doesn't end up watching this, but I'm a renter because I'm basically paying 2% to live in a house that's far nicer than a house I'd want to buy. And there's a slight annoyance that, last time I moved, getting a horde of removals guys to come and take down the beds and all that stuff was quite expensive, but it was nothing like stamp duty. It was like the frictional cost of me moving from one beautiful family home to another beautiful family home where I'm paying where if you take that 2% point, I could rent the house I'm sitting in for 50 years assuming the price stayed the same, before I would have spent the same amount of money if I buy this house. Now, again, I'm taking that view, and I've only, it's also, property is an intensely personal thing. It really depends on what you want. That suits me for a variety of personal reasons. But I do think that, if rental yields are 2%, 3%, or even 4%, you're probably better off renting. Because you can return 7%, 8%, 9%, 10% in all sorts of, rather than put a massive amount of your net worth that you've spent years saving up into the deposit on a house, have that in the stock market or sensible financial investments, or a multi-asset fund, for example, perhaps, and rent. And I just think Britain, property is problematic because everybody thinks they understand it because it's such a national obsession. It's in the papers. If you live in London, you get the Evening Standard every Wednesday night. It's 60 pages of property stuff, and I'm sure the same as ever else. I sound very London centric, but I suppose I live here, so that's why. But nobody's thinking about nominal versus real. Very few people are actually doing the real, really crunching the numbers, and making assumptions such as what happens if interest rates go back to 9% or even 6%. Which may happen. That's probably not that helpful. But I suppose the one other thing I would say about property as a general rule is, if you own a property, if it's your main residence, you should probably make sure you own a bunch of other financial asset classes before buying more property.
Oh, I'm with you on that for sure. Yeah.
If 45% of your post-tax income is walking out every month on your mortgage, or even more. I know a lot of people spend more than that on their property, which I think is, I would rather be a longer commute away or live in a smaller place than deal with that, because then I think your finances are fundamentally imbalanced. Although I will just caveat by saying that I do understand that, if you're 22, you've just graduated from uni or whatever, and you've moved to London, and you're on 18 grand a year or whatever, being extremely badly treated, but as an intern at some media company or software or whatever, as I know lots of young people are, and what a tricky time it is, that is a period of your life where you might have to just pay up a bit more. But still, don't live in Chelsea, live in Catford. I bought my first property in London, in Borough, and all my mates from my uni and my school lived in Notting Hill and Chelsea. And it's like, okay, but and there are certain of them, mummy and daddy help them out, but I made a lot of money in my first property there back between 99 and 03, which set me up. But and now I'm a renter. I think too few people actually build a model, think about what mean reversion, think about where interest rates are going, and think about rental yields. If rental yields are 7 or 8%, buy, and if they're 2 or 3%, rent. So I suppose that's
perfect, nicely put. That's right. It's to me, it's the obvious way to value something, and that's why I suppose a lot of people buy property, buy-to-lets up in Hull and places like that. But at least then you're going to make your money back pretty quick if you've got a rental yield of 8%.
I think that's right. But the other thing though that I think a lot of people forget about property is it's also a massive pain administratively. I actually use the example in the book. So in the time I lived in my apartment in New York, which was just over a year, I made 40% in my gold and silver investments. I had to click a mouse once at the beginning and click a mouse at the end. The rental yield on my flat I was living in New York was 2% for the owner, based on what their asking price they wanted versus my rent. And so, the owner of that, and that's not accounting for the price of money. I don't know what interest rates were in America in 2010, probably 4.5% or something. So they were losing, assuming they were borrowing money to fund that property, they're actually going backwards whilst I was making money in gold. Anyway, I think that stuff's, I'd like to think that, I think it's chapter 6 of the book, which is called Creating Financial Surplus. Thank you very much.
That's right. I have it in front of me.
The chapters have changed order a bit. Along
Number 5, chapter 5.
Number 5. There we go. How embarrassing! But chapter 5 of the book basically does a bit of a deep dive on all these. How do you think about property? And sorry, in the final, without wanting to be too rude about professionals, but, particularly in America, I didn't meet an estate agent who knew what rental yield was.
Scary, isn't it?
Yeah. No, funnily enough, America had a galumphing massive property crash, and I've got some mates who live in Seattle, And the worst example I'm aware of were plots of land in Seattle that were selling for something like, I think it was $1 million that eventually sold for $1,500.
Man alive.
That's how
a
bad
crash,
it
isn't
gets.
it?
Yeah, well, exactly. You're going to be on the wrong end of that one, would you?
No, for sure. It is scary just how little professionals know sometimes. I had a client call in yesterday, lost her husband late last year, and she is executor. He has kids of his own, and so she will benefit from his ISA balances at the time,
right,
because of the additional permitted subscription. So she has money outside an ISA and money inside an ISA, and she knows that she can shift money to the value of a late husband's ISA into her ISA on a one-off opportunity. But every single she went into the 2 building societies that he had ISAs with, and they just couldn't get their head around it.
And so you can't do that. You're going to breach your ISA limit.
Yeah, exactly. She she rang the HMRC. Who unbelievably put her onto the ombudsman, and they're just why on earth would you ring the ombudsman about that? You think that even the industry, this is a pretty fundamental, really not a difficult thing to get your head around, and yet people on the front line are not able to answer this. Now I know you have strong views, Andrew, and I share many of them on the advice industry as a whole, largely I guess down to remuneration models historically. Is that right?
Well, and training. I mean, just coming on to that point about, so the first edition of my book, 2 little stories, 2 little vignettes on this theme. So the first edition of my book, I was advised when I had the first draft, somebody said you should get a professional editor to go through it. And so how do you do that if you don't have a literary? I didn't have a literary edition back then. I was an unknown first-time writer with a homebrew Word document. It makes me laugh now to think back. But but there was I can't remember. I won't name the company actually. So even if I could remember, but it was a company that basically puts people like that in touch with professional editors who've had careers in journalism and as agents, literary agents, whatever. So I got in touch with this guy who was in his probably, I would say, his late 50s, who was allegedly a finance expert and an expert on personal finance and an editor. So, and he'd been an editor of personal finance books, and he'd been a financial journalist, and he was, as I say, late 50s. So he took my 90,000 word document away, and I'll sound terribly smug saying this, and told me it wasn't very good and it would never see the light of day. Pleased that it's now the number 1 best-selling book in the UK in finance. Sorry, I sound terribly smug. But,
quite right too. I reckon
well, this version. Let me be clear. This version is a much better version than that version. So to give him his due. But he, so he did an editing job, and one of his criticisms was that in the section on ISAs, I kid you not, he said, I've looked at the back page of the Sunday Times, the Financial Times, whatever, this week, and the highest ISA return I can see is 1.8% or whatever. Your ideas about making high single digit, low double digits in an ISA are unrealistic. What a load of nonsense, young man, kind of thing. I'm like, hang on, are you talking about you're talking about cash ISAs? Yeah, you're not stocks and shares ISAs, right? What are they?
You're joking.
I'm not kidding.
Terrifying.
I'm not kidding. So it's exactly. So here's a guy who literally had been a financial journalist for 4 decades or whatever. Now, maybe that's bad luck, but that's one story. I could tell you many others. In terms of IFAs or FAs, because
nice.
Well, no. By which I mean they're not independent.
I know.
Tied, because the story. Yeah, good. I wasn't. Anyway, let's move swiftly on.
You weren't referring to what they actually do, no?
No, because I think that's a bit unfair. But maybe in this case that would be very relevant. Ironically, we can conflate the two. But so I walked into a high street branch of one of the big, I won't say the name of the, Barclays, Lloyds, NatWest, Santander, take your pick. They're all the same anyway. And that's a bit unfair. Barclays is probably a cut above for stockbroking services and stuff. But one of them, to have my, review with one of their financial advisors, who was of a certain age, i.e. quite young.
Shiny suit.
And what's that?
Shiny suit.
Obligatory shiny suit.
Yeah.
I won't comment any further. and thought that I should probably get some ISAs invested, which of course I already had. I think with Fidelity at the time, and that person was unaware that there were any ISAs other than the ones that firm offered. So I said, no, I've got my ISAs with Fidelity. Who are Fidelity? So, and by the way, that was in a high street branch of that bank. in the city of London. That wasn't in like, a tiny little rural town in Devon or something. It was on Moorgate in the city of London. Amazing. And I just sat across the table from this person thinking, what do you do every day? I mean, you're surrounded by the whole industry right here, and you don't know what a share is. You don't know what a bond is. You literally don't understand anything other than the five. I was just about to name the brand, which I don't want to do, but the five. It was like a UK balanced fund and a blah, whatever. All of which were too expensive and rubbish. But that person selling those things had only ever been trained, presumably over one weekend in like an outward bound training centre where they send hundreds of them from all over the country, and probably never picked up the FT, never picked up Money Week magazine, never done. And these people are giving advice, and this is one of my big points. There's so many people in Britain, when they get to late 20s, early 30s, and they have some money to invest, and they've had that little voice in the back of their head for a few years, going, "Oh, I've got to stop spending it all on the pub or on hi-fi equipment or handbags," or without wanting to be too cliched about men and women, but whatever floats people's boats. They think, well, I'll go into my bank and try and organize a savings plan or whatever, and they get absolutely hosed because the advice they get is from people like that.
Yeah, it's true.
And I used the example of precious metals, we went into earlier. You will never end up owning gold and silver if you use a high street bank. So it's just not going to happen. They don't know anything about it. They don't know how to invest in it. They don't know. And that's a scandal.
And they don't make any money out of it, do they? They're not incentivized to sell it. And we can... Right. Yeah, obviously, we joke about shiny suits and stuff. That is, obviously a bit of a cliche, but you're right. It is training level. It's deep understanding of the psychology of money, and actually, the money is a tool as a means to an end rather than an end in itself. All that sort of stuff that you and I talk about all the time. But the profession, the industry, is not set up to encourage that in its new entrants. So, as we were saying before we hit record here, had a young advisor, considering maybe working for me here at Jackson's, very bright spark, I'm sure will do very well. But right now, even at 26 years old, he has been, in his very limited work experience so far, he's been groomed to do well in a dying model. We will pay you a percentage of the stuff that you sell. And it's just nuts. But he's saying the right things about how he wants to be mentored and how he really wants to get into financial planning and work in a team, all that sort of stuff. But still, he's thinking, but actually, I'd quite like to be paid, a lot of money. A lot of money. And thinking it doesn't work that way unless you own the business now. But
I think the FCA, the regulatory situation bears a responsibility for this, because all the changes, it's like the law of unintended consequences. All these changes have been made to try and protect, mum and pop investors, Mrs. Miggins, whatever, from shiny suited, skullduggery, have ended up making things a lot worse. Because now the costs of, the costs of being regulated, the complexity, the exams, the endless paperwork, red tape, are just enormous, such that, you can only really work with very wealthy people, and make a living as a financial advisor. I know the more cynical of your viewers watching this will think that I'm being slightly disingenuous, but you have to work incredibly hard, and you have to work with people with quite a lot of money to make a difference. And that has been one of my biggest challenges with Plain English Finance, is helping anyone, helping somebody who's got 50 quid a month or even 25 quid a month, within the confines of what I'm allowed to do and say as an FCA regulated and authorized business. And it's incredibly hard. I happily, I don't know when I came across this idea, maybe when I was working in Washington, but Mark Twain's idea, write for free until you get paid. The whole basis of my business is that we've been doing an awful lot effectively for free and at our own expense. Everyone in the business has contributed untold hours for equity, basically for sweat equity. Now, clearly, if I end up with £1 billion fund, that will have been time well spent. But nevertheless, it's just at every turn, one of the biggest barriers to just being able to help people is the regulatory piece and what you're not allowed to say, and the fact that if I still get, it's probably going to be one of the next few emails I'm going to send out to our email list will be a big picture, sort of holistic piece on financial advice and how it works in the UK, and why, I get lots and lots of people who read, the book is selling quite a few copies every month, and I get lots and lots of emails from people saying, thanks so much, so excited, and then giving me a big laundry list to give them, please tell me what to do. I've got this much money, and expect me to spend 1, 2, 3 hours of my time just replying. Which which to a certain extent I've actually done a lot of within the confines of what I'm allowed to do. But what they don't understand, which is a real cognitive dissonance for those of us in the industry, is I'm not allowed to.
I know.
And by law, unless I actually invite them, to my office, sit down opposite them, and go through a 60-page form of formal questions about the KYC, know your client, and ask them all these really in-depth questions about their debt and their attitude to risk, and their income and their outgoings and all that. At the end, and we contractually sign a piece of paper saying we have a contractual, relationship. I am not allowed to help them. My goodness me, a lot of people get very, very shirty and pissed off with me.
I know.
Because and my hands are tied. But and then we have a Facebook community which students can join for £2 a month, and everybody else can pay £5 a month. And I still get people go, a bit bloody cheeky, charging like a £5 a month. It's like compared to the thousands of pounds that you'll have to spend to get any half decent financial advice. But sadly, our hands. I know you agree with this, but the way that the regulatory piece is set up makes it very, very difficult to help people with their finances in this country without all this cost and complexity.
It's a bone of contention with me that if I wasn't regulated, I could pretty much say what I want.
Well, and this is why I'm not an angry person these days. My wife might tell you differently. Who knows? But I think I'm quite an even-tempered person. But watching the crypto nonsense of the last few years. Now, don't get me wrong. I think Bitcoin has a lot of similarities to gold, and obviously I'm a massive gold bull in terms of being a hedge against fiat currency and maybe a stable. I mean, it's not at the moment. One of the key requirements of any currency is that it's relatively stable. And you can't say of something that goes from 40 to 20,000 back to 3,000 and then to 12,000. You can't call that relatively stable. It can't function as a currency whilst it's that volatile. But it's the fact that any punter could get onto Facebook and start a business in the last few years saying, I'm an expert on cryptocurrency. I'll help you become super wealthy in 10 minutes, with no regulation from the FCA.
Yeah, scary, isn't it?
And it's just mind blowing to me. And so many people have been completely hosed, have lost, life savings. I was in social media groups where I saw people buying crypto on credit card.
Oh my gosh.
Near the peak in the last quarter of 2000, and being egged on by these sort of characters. As I said in the third edition of the book recently, this stuff is really important because it actually people commit suicide.
Oh yeah.
In 1999, 2000, in the dot-com crash, suicide rates in Europe and America skyrocketed, and the same happened in 07, 08, 09, and it's happening now because of all the people being hosed in Bitcoin, and they're not regulated by the FCA. I cannot begin to understand how that can be possible. It's
a massive public failure, isn't it? If that's the case. Adra, I could talk to you all day, man, because we're clearly on the same page on so much of this stuff. What's next for you and Plain English Finance and all that sort of stuff? What's happening?
Well, if I'm allowed to be slightly, you
can. This is your opportunity. Yep.
Well, thank you. I mean, a lot of people understand this, but the success of the book put me in touch with a few people. Years ago, you said to me, what's your ultimate dream? I'd love to run an investment fund that implements these ideas. Basically, all geographies as effectively as possible in one place. One fund that sounds like the Lord of the Rings. One fund to
rule them all.
Yeah, exactly. Because there were a few of those. I used to recommend ones, but they weren't quite the finished article. And through luck, not judgment, I had two professors from the Cass Business School, pretty, very high-profile guys. One of them, Professor Andrew Clare, actually basically sets a lot of the finance exams in the UK for the CFA, for example, right. And which is what sort of investment bankers and hedge fund people study. He's the exam. He sets the questions.
Amazing.
So and used to work as a senior economic advisor to the Treasury. His colleague, Professor Stephen Thomas, the two of them are both rated as kind of the top. Even in the top 10 of most prolific financial academics in the world over the last few years. And just purely by chance, they got in touch with me a few years ago. I think one of their postgrad students at Cass in London had read my book and said, look, and we started talking about setting up an investment fund, and then the rest is history. We now have an investment fund.
Brilliant.
So what's next? What's next for me? I mean, the problem with investment funds, launching an investment fund is the biggest, unless you are Fidelity, Aviva, Polar Capital, Standard, Aberdeen Standard, whatever. Unless you're a huge brand where they just sort of at the slash of a pen go, right, you can have 50 million quid and start a new multi-asset fund or whatever. Getting one off the ground it suffers from just a complete chicken and egg conundrum, which is until you've got a 3, 4, 5 year track record, nobody's going to invest in you. And until, and you can't, and the fund's not economic until you've got at least 10 million quid in it. And really, ideally more like 20, 25, 30. But because of the audience we had with the book, we managed to, build this kind of spider web of advisors and launch what I think is a really, really compelling investment product. It's a real tortoise. It is the tortoise. And we're now 18 months in. I'm hoping that 18 months from now, which is when we hit our 3-year anniversary, we'll have demonstrated the efficacy of the strategy. And at that point, we'll be able to go to more IFA firms will be willing to kind of, or even just, more mass affluent people will be able to put their ISA into it or else. It's now about 11.1 million quid, I think.
Amazing. What's the name of the fund?
So it's a very catchy name. I wanted to call it the Own the World Fund. But the FCA thought that might mislead consumers because they think they literally owned everything in the world. So we weren't allowed to call it that. So we use ValueTrack as our fund administrator, which is a firm in Scotland. So in common with about 60 other funds, it starts VT for ValueTrack. And it's called the VTPEF, Global Multi-Asset Fund. Last year, the FTSE was down 12.5%, the all-share was down 13%. It's a multi-asset fund, so it's a slightly disingenuous comparison, but we were down 6-ish, just over 6. This year to date, we're up 8. And actually, we've backtested to Jan 2001. It's done 7.52%, with all the sort of exciting hedge fundy ratios are quite impressive. So basically, the worst ever down year was minus 6% in 2008, but it's had 4 years of greater than 20% return in that time period. So basically, it's a really good product for pegging the downside. The worst thing it does is go sideways very boringly, shuffling along like a turtle. But to go back to my point earlier about the break-even fallacy, so not a lot of people, the break-even fallacy is that if you ask the average person, if you lose 50% on your pension, what do you need to get back to square one? So the 100 grand in a year like 08 goes to 50 grand, which it does, and it did. How much do you need to make to get back to 100 grand? Most people say 50%.
Nope.
The actual answer is 100%. So if you lose 25, you need to make 33, and it gets more and more extreme, which is why if you lose 75% in Bitcoin, like people did last year, you need to make 360 something percent to get back to square one, which is why you should go for lower volatility products. And so what's next for us is just more of the same, selling lots of copies of the book, doing, I love doing these calls. Thank you very much for having me on.
Been great
doing this. Well, thank you. Doing this so people know about it. And then, demonstrating that what the fund we have is a really good kind of, especially for somebody who's 60. Because if you've built a pension pot of £500,000 quid and you're 60, you've got to get into something that protects the downside. Because definitely. if you going from 10 grand to 6 grand when you're 25 because you're in a biotech fund is a lot less of a problem than going from £1 million quid to 600 grand when you're 1 year from retirement. Massively, which sadly a lot of people do.
Yeah, it's true. So where can people find out about all this stuff, Andrew?
So very simple. So the website is plainenglishfinance.com, .co.uk and .com both work. Okay. Whichever one. And it's called How to Own the World. You've obviously got a copy. You got a copy there. I should have a copy with me, but there it is. Thank you very much. And that's available. I mean, these days, obviously, most people buy it on Amazon. Amazon are very kindly. It's $12.99, but it seems to have been £8 something for the last few months. Yeah, because they promote books that are, have a bit of sales momentum. So they've been doing that.
Well, look, man, I'll make sure there's links to all that on the show notes.
Thank you very much.
Andrew, it's been great to speak to you and great to meet you.
Likewise,
actually, like I say, as a clear kindred spirit. So I wish you all the well, all the very best.
Where's Jackson's based?
We're in Penzance, in the very far southwest of Cornwall. So I'm a Yorkshireman originally, but married a Cornish girl. My wife Joanne is from Sennan, which is 1 mile from Land's End. So that's why I'm all the way down.
Well, I was in Exeter last Monday actually. So I get down that neck of the woods sometimes. Well, I know it's not quite as far.
Not quite. You got another 2 hours to go after Exeter to get down to me. But look, Matt, thanks for joining me. Really appreciate it. All the very best with everything that you're doing. Take care.
Thank you very much, Pete. Cheers.
Cool. Nearly 56, 57 minutes, but I hope you agree that it was worth it. I literally could have talked to Andrew for 3 times that long and not lost any interest. He obviously knows his stuff. That is evident. And the passion comes across as well. I'm sure you'll agree. So I hope you enjoyed that. Cool. So, Andrew, thank you so much again for coming on. All the links that you need to know, of course, in the show notes, meaningfulmoney.tv/session334. Everything you need to know is there. Here's this week's review from Alexander P! ! Best podcast for people's finances. Thank you, Alexander. What Pete does here is amazing. He provides all you need to know and all you need to do to manage your personal finances. Listening to this podcast has helped me understand more about the purpose of money and how it works. I've set up my long, mid, and short-term goals, have started budgeting, saving enough to invest appropriately for each one of them. This is not just another podcast, but a source of priceless information. Keep up the good work, Pete. Be certain that all of what you give away for free is compounding. Amen, brother. You are set on the road to be a legend. Actually, I'm after a knighthood. So if the community could organize that, that'd be great. Thank you very much, Alexander. I really appreciate you leaving that review. If you want to do that, then meaningfulmoney.tv/iTunes if you're of an Apple bent. But really, wherever you listen to this show, if you are able to leave a review, please do so, because it really, really helps. Okay, exciting one next week. I've really enjoyed this season of In-Between Episodes. Spoken to some really cool people. Next week is Brad Barrett and Jonathan Mendonza from ChooseFI.com. Another sort of guests by popular demand, if you like. So I had a blast chatting with Brad and Jonathan. Very different personalities, clearly complementary, but they're doing great work. So I'm really looking forward to bringing you that conversation with Brad and Jonathan next week. We had a lot of fun. But that's it for this week. So thank you so much for listening. Hope it was helpful. Thank you again to Andrew for coming on. If you've got any comments, you can do that at the show notes, meaningfulmoney.tv/session334. Andrew, I'm sure we'll dive in and answer any questions you've got there. Plus all the links are there, so you know where to go. Hope you enjoyed it, folks. Thank you so much for joining me. I'll talk to you next week.